This is Philip Chow. I'm the founder and chief investment officer of Experiential Wealth. Since the August speech at Jackson Hole by Chair Powell of the Federal Reserve and the subsequent September regular FOMC meeting, Chair Powell had made it very clear that job one is to bring down inflation. There was some ambivalence in the past, at least interpreted by the market, that the Fed may slow down, the Fed may pivot, the Fed may not be able to carry out whatever actions that they need to bring inflation back to 2%. I'm talking about core inflation. Well, those speeches made it very clear that no uncertain terms, even if it costs the economy something, even if it costs a higher unemployment rate, whatever it takes, the Fed is ready to make those changes. Where we are now is we are already at over 300 basis points or 3% in interest rate on the front end. And we are looking at most likely going to be around 4.25% by the time this year ends. So there's a lot more to go. And there's will be more to go after that. Based on the information that we have about inflation and based on the information that we have about high frequency data on where the economy is, we still have a very strong labor market. We still have a very strong, actually, consumer who are still spending on average. So if this continues, that means if Fed is true to its words, is that we'll continue to raise rates and we'll continue to expect rates to be in the 525, 5.25 to 5.5. The problem is, how high can it go before everything breaks down? When I say everything breaks down, a very severe recession, there are issues on credit, issues on bond pricing, issues on a lot of other things, a very technical term, that is going to make the economy weaker, going to have much higher unemployment than we anticipated, and so on. And there may be a financial shock from certain financial institutions, lack of liquidity, and so on. And what the market is expecting is that when that and if that happens, the Fed will come in, lower rates, and then start buying bonds again, and really have to abandon this strictly trying to control inflation approach. We don't know. There's a lot of speculation because it is facts and circumstance. So as a result, what we can say is that for now, rates are going to keep going up until something breaks. And we think something will break. Then the question is, when it breaks, what will the Fed do?